This week in economics from WBRN Radio in Boston on the Bostonred Network, known as the Numbers Man Show on many of these outlets. Nonetheless, this is on the 30th of December 2017, our last show of 2017. We'll start this off, and we normally would not do this, but with the latest information from the National Association of Realtors, it's titled Tax Cuts and Jobs Act, what it means for homeowners and real estate professionals. We'll append this, so we're not going to go over all of it. But this is the tax brackets on the current law and under the new Trump Republican / act. On the current law, these are the tax brackets. At 10%, those are making up to $10,000, and that will remain there under the Act. And at 15%, that is roughly $9,525 to $38,017, taxed at 15%. It'd be taxed at 12% under the new law. And this is where it gets very interesting. From $38,000 to $93,000, that's taxed at 25% on the current law and 22% under the Act. And then you move to $93,000 to $195,000. It's at 28% on the current law. It'll move to 24% under the Act. And at 33%, that is $195,000 to $424,000. You won't see very much there. You'll move from 33 to 22 there. But, however, though, we'll let's see, a little different here. In other words, I didn't put the payouts here. Where they have been adjusted somewhat at the 25% rate. Actually, that will go 22% to $82,000. It's at 93 now. So you're seeing some adjustments here in the Act, and we'll just finish it up at the 39% rate. That will drop to 37, and it will actually go up to $500,000 now. It's at $426,000. So there will be some adjustments in that. Tax brackets for ordinary income under current law and tax cuts. This is for married. That was single we gave here. We won't go through all of these, but basically, if you're in the 39.6 bracket, that starts at $480,000. Under the new, it'll be at 37 at $600,000. And this is how it affects mortgage interest deduction. The final bill reduces the limit on deductible mortgage debt to $750,000 for new loans taken out. That will be after the 14th of this month, December 2017. Current loans up to $1 million are grandfathered, not subject to the new $750,000 cap. Neither limit is indexed for inflation. Homeowners may refinance existing debt on the 14th of December up to $1 million and still deduct the interest rate. Now, some are doing that. The new loans does not exceed the amount of mortgage being refinanced. The final bill repeals the deduction for interest paid on home equity debt through 12/31/2025. Interest is still deducted on home equity or for second mortgage if the proceeds are used to substantially improve the residence. So you get a home improvement loan there, I suppose. Deductions for state and local tax. Now, this was a big contention there. Itemized deductions up to $10,000 of the total of state and local property taxes or income are sales tax. The limit applies for both single and married filers. The final bill also specifically precluded the deduction of 2018 state and local income tax paid in 2017. So the final bill is less beneficial than current law, represents significant improvement over the original proposal. Anyway, the Senate and House bill would allow property taxes to be deducted up to $10,000. Now the standard deduction has changed. It's now at $12,000 for individuals and $24,000 for joint filers. Under current law, you can filers can deduct up to $4,150 in 2018 for the filer and his spouse. These exemptions have been repeated, and this is a repeal of personal exemptions. Okay. The mortgage credit, medical expenses. Now the final retains deduction for medical expenses, including 10%, decreasing from 10% to 7.5%. The child's credit is going to be there. Will increase it to $2,000 from $1,000. Student loan, that has been kept up to $2,500, subject to income phase out. Deduction of casualty or loss. The final bill provides a deduction only if the loss is attributed to presidentially declared disaster areas. We won't go into all of this, but let's see what else here. Low-income housing credit. This is one of the things that the final bill retains the current law. However, a lower corporate rate will negatively impact the value of the credits. And let's see here. We'll just append this as the easiest way to do it. Private prisons. More of this in here. Investors who bet on private prison operations are big winners in the tough line on crime. This stock's still good value even at anticipated windfall here. They named several of them, Geo Group and Core Civic, stand to win contracts for states struggling with prison overcrowding. They cite here the state of Kansas and Oklahoma. They operate, which operate as prison real estate investment trusts, in other words, REITs, and long-term federal contracts with minimum revenue anyway. So a lot of that is to ICE, which determined that have not recovered. It now trades at, this is Core Civic. We'll be talking a little more about this in a minute. Now trades at 37% below its post-election high. Geo is at 32% below it. So there are some problems here with these stocks here. Now the Immigration Service, ICE, is the main customer. An average of $129 per day accounts for a quarter of the revenue in the 9 months. And this is of Core Civic and Geos in 2017. ICE asked Congress for $1.2 billion fund increase, but the latest budget proposal offers $700 million. So they will get less. A pending Kansas proposal to build a new prison, which the state would manage, would address some investor concerns. In other words, it's not as rosy as thousands of vacancies at facilities also viewed as positive because they could lift earnings there. So in other words, these are Reeves, a little different situation here. Let's go to the quarterly report. That was from Reuters, and this is back Wall Street Eyes 2018 gains with a bit of caution. This was written on the 29th of December. U.S. stocks expected to continue to rise in 2018 because of a massive drop in the corporate rate is seen as boosting the economic and corporate profits. The bull market is on track to mark its 9th birthday in October. The S&P climbed 20% in 2017, its biggest increase since 2013. The drop in corporate rate in 2018 to 21% from 35 is seen as a big factor in the market next year. Yet 2018 share gains expected to be smaller than 2017. This has been a continual theme for many things that 2018, there's some interesting things going out there. Last week we talked about consumer debt for the Santa holiday season, buying season. A lot of people dipped into savings are charged, which means they're going to have less disposable income. Another thing we're concerned about is the price of gasoline, petrol, when we get to Brent crude, up over $65 there. That in itself is not good, and several other commodities have been going up. Let's get back to this. We've had 6 years in a row. Stocks have outperformed earnings. I think we break that streak with stocks going up, but not as much as earnings. This is from Robert Dahl, Chief Equity Strategist at Norvine Asset Manager in Princeton, New Jersey. Some say the tax bill will be short-lived. That's from David Kelly. He's Chief Global Strategist at J.P. Morgan Asset Management. Described the bill as more carb and less protein. Interesting analogy there, because the tax overhaul will improve spending but not do much for productivity. It'll be a one-year wonder, according to Kelly. Now, this has a lot to do with the psychology of the market, particularly economic psychology. If you recall, during the Obama administration, we had a lot of pessimism out there. And I remember we were doing several programs where we talked about the psychology of the market. And when you have a lot of pessimism, things tend to grow not at the normal rate, but a subnormal rate. But yet you still, in this degree of pessimism, particularly with the Affordable Care Act, Obamacare, and then in the campaign in 2016, the continual driving home by the Republican Party candidate, DJ Trump, about GDP staying at around 2%. Now, we've had 3%, but the problem here is sustaining even 3% or 3.5% or 2.9%. That's normally not done in industrialized capitalist society. Let me continue on here. People should enjoy the party. This is according to Mr. Kelly while it lasts, but just make sure you know where your code is. Several strategists cite the risks that a fast economic growth could cause inflation to increase at a pace where the Fed would step in to raise interest rates faster than expected. Well, that is always one of the problems, that you have this so-called fast growth. We're beginning to see some problems here with Apple deliberately slowing some of their devices because of battery life there. You start to see more and more of that. Wall Street rosy forecasts seem well supported by tremendous string of good news which the economy has delivered. That's Jay Paulson. He's the chief economic strategist with Lee Holm Group at-home group in Minneapolis. But he says the news is too good. Well, it is. The problem with getting good news is that at some point you can't be positively surprised anymore. Paulson does not expect a recession, but when the surprise index, which we'll go into in a minute here, which compares economic data to consensus expectation, is at a high level, equity performance tends to be weakened. Well, no doubt. Now, this is Citi's economic surprise index, was at 77 on Thursday, not far from the 6-year high of 84.5. That was on December 22nd. We're going to have a 10 to 15% correction in 2018. The problem there is you can't accurately predict if it's going to be a 10% or a 15% correction. It could be more or it could be less. That's 5-point difference there, but a lot of it will depend on reporting, and again, we'll get into this in a minute, using a January as the month. In other words, your performance in January, we're giving you as Q1, sometimes can reflect the performance throughout the year. That's not necessarily true, because if you recall last year, January Q1 performance, or Q4, was subpar. But again, you had Q3 where you had roughly 3% growth, and Q4. So investors will keep a close watch on the midterm elections. Another part of the puzzle, because the Republican loss of control of the Senate and the House of Representatives could stall the party's agenda. Well, the thing with the party's agenda, most of the Republican Party's agenda will be in place before the 2018 elections. Because this year is 2018, we're coming on, we'll call it this year. They'll be looking at quote-unquote entitlement reforms, but they first have to take care of the budget. In other words, the deficit, that has to be raised, and that'll be preoccupied them in January. They decided to go with it, because when you start dealing with quote-unquote entitlements, you're dealing with Medicare and Medicaid. Those are big entitlement programs that are out there, and forget about Social Security because it's not in the bulwark. But the whole problem is with Medicare, a lot of the Republican supporters are on Medicare, and a lot of them, due to where they're located, are on Medicaid, and Medicaid particularly for nursing homes and those kinds of situations. Nonetheless, in 10 out of 17 midterm elections, equity prices move for the full year, following January's direction. Now, this is from Jeff Hurst. He's and we'll look at him, the Stock Trader Almanac. Now, this is a debt ceiling. Investors will be hoping Congress can reach a 2018 budget pact by the 19th of January. They don't, there's some there, but the market has a history against it. The S&P 500 on average rises 1.3% for the so-called Santa Claus rally this time around. This is from December 22nd to January the 3rd. According to Hertz, this year, the 5 days it's risen only 0.1%. So it's out more than 1.2%. The failure to rally during this time tends to precede a bear market, or at times when stocks could be purchased at lower prices later in the year. And he wrote on his blog. We looked at his blog here. This is Mr. Hirsch, the Trader's Almanac. So, mid-January performance has quite a legendary repetition. January does. The influx, of cash from year-end bonus annual allocations typically propel stocks higher. Sorry about that. January's ranks number one for the Nasdaq since 1971. But 6 for the S&P 500 since 1950. It is the end of the best 3-month span and possesses a full document of indicators and seasonalities. In midterm years, January ranks near the bottom since 1950. Large caps have been worst, with the S&P 500. The Russell 1000 ranks 11th. The second worst, Dow Jones 10. Technology small caps shares fare slightly better in ranking, but the average performance is still negative. Free trading days after the Santa days, the historic averages here. The average is 0.22. That's free days at 0.5.09. These are some of the averages here. For the 500, 0.25 is the average, and for the Nasdaq, 0.31, and the Russell 2000, this is from 1986 to 2016, 0.70. And number of ups, 19, number of downs, 12. I should have given those. This is for the Russell 2000. For the Nasdaq, up 17, downs 14. S&P 500, where the money is, 18 ups and 13 downs. We'll just put this on. The trends, the trading days were somewhat lackluster this year. The free trading days following the Christmas holiday break. Also bullish track record over the past 31 years. The free day rank up and near the top compared to all other market holidays. The average and medium gains are fairly, the Russell 2000, fairly stable and consistent each of these days. The free days are the heart of the Santa Claus rally. This year, a positive is the first step towards a positive January indicator. Well, trading ahead of the Christmas is usually bullish. Stock Traders Almanac has tracked the performance of the market around major holidays for decades. The most recent stats can be found anyway. You won't be able to find them. You can order his Almanac. Holds the honor of being the most consistently bullish of all holidays. This is the Christmas holiday. And the Russell 2000, the average gain on the day before Christmas and 2 days before Christmas were not for some sizable declines in 2000. Anyway, so much for that. We'll move on here. Goldman has warned of, $5 billion earning hit from the new tax law. A little bit more on the tax law. Some set to take effect on Monday. Sweeping tax code change there. Were expected to mean a short-term pain, but long-term gain for U.S. corporations like Goldman. Goldman has stored away billions of dollars of profits abroad. They've been playing this game for a while, and are expected to mean short-term pain. Sorry about that. To avoid the 35% tax, the new law encourages companies to repatriate these earnings and slaps a mandatory tax of 15.5% on cash and liquid assets, 8% on illiquid assets, regardless of whether they were earnings that came home or not. Scores of companies, including Citi, J.P. Morgan, Chase, have stalked away $2.8 trillion overseas in recent years. The one-time tax on earnings expected to raise $339 billion in revenue over 10 years. That's according to the Joint Committee on Taxation. This will hurt multinationals for a while, but they will have 8 years to pay the taxes due. Some U.S. Financial companies have disclosed the hits related to deferred assets from losses they suffered in the Depression, 2008 to 2009. Citibank says expects as much as $20 billion charged to earnings for this, while Bank of America has detailed $3 billion to fourth-quarter profits. The negatives should be more than offset by long-term charges here. Foremost among the profit-enhancing changes will be deep cuts in the overall tax down to 21%. The cut federal tax bill more than $1.3 trillion over the next decade. Under the new territorial system, domestic profits will still be taxed, but profits earned abroad by U.S. multinationals within limits will no longer be taxed. This was expected to reduce the federal tax revenue by $224 billion. That's over 10 years. A new law, multinationals have pushed for many years for a discount on their deferred there. So in other words, some people responded, some people didn't, so it's pretty good out there. Birkenstock, evidently, and Amazon are not getting along these days. A lot of phony products out there, variations of Birkenstock in the Google AdWords. You have to spell it correctly, so they are not putting anything on Amazon anymore. This is from Dr. Yarnish. His blog here, the stock market continues to soar. It's attracted more money into stocks. What usually happens during melt-ups instead of meltdowns. I think the market will be in an early stage of melt-up. I will call it a melt-up if my 2018 year-end target of 3,100 for the S&P is reached within the next 3 to 6 months rather than 12 to 18 months. Some observers reaching 3,100 by the end of next year may appear to be a melt-up, since it would mean that the S&P 500 would rise 51.7% over the 3-year period. Now we're talking about 2016 to 2018, and maybe so, but we'll see whether the earnings continue to rise, providing fundamental support for the gain so far the year ahead. A cut in the corporate tax effective next year will continue. Deregulation should boost profits there. Meanwhile, the flow of cash case for the melt-up is mounting. More hot money into equities over the past 12 months through October has attracted $375.6 billion of new money. Admittingly, some of the money might have come out of equity mutual funds, which have a net outflow of $51.7 million over the same period. Collectively, equity mutual funds and these ERFs have a net income flow of $323.9 billion. The best pace since September of 2014. So far, exuberance for stocks reflected in equity fund inflows is supported by exuberance of industry analysts for the outlook of the S&P 500 revenue and earnings. This week, data from revenue and earnings has shown that the industry analysts are turning increasingly bullish on the outlook for the S&P earnings. They're projecting earnings gain of 10.9% this year, 11.4% next year, and 10.1% in 2018. 19, presumably these numbers don't fully reflect the likely big positive impact of a cut next year. If that happens before the end of the year, analysts may wait until Q4 calls during January to get some guidance from the company management. Forward earnings is set to a record 145.6 that's dollars per share, up 13.2% above Q4 earnings there. So this is his blog. I won't go into all this. And he further breaks it down here. In the realm of economics, there are a lot of theories. There are a lot of urban legends, and he quotes Daniel Patrick Moynihan here. Everybody's entitled to his own opinions, but not to his own facts. In today's world, fake news, sorting out facts from fiction is a challenge. In the realm of economics, there is no shortage of data, which can be very helpful in discerning the difference between information and disinformation, which brings me to the subject of the U.S. corporate tax, which Republicans are aiming to cut. He wrote this, incidentally, in early December. The GDP data yesterday, that's for Q3, includes corporate pre-tax and corporate after-tax data. But the data says that the corporations paid $472.9 billion in taxes over the past 4 quarters. That's through Q3. This has been hovering around a record territorial high of $500 billion since Q2 of 2014. Dividing the tax series by pre-tax profits of $2,281 billion over the same period, shown that the effective tax rate had been significantly below the statutory rate starting the previous decade. During Q3, it is 20.7%. The Treasury data, the plot thickens. Actual corporate tax revenue collected by the IRS consistently less than the corporate tax included in the GOP measure. Set the series from 1972, for example, over the past 4 quarters through Q3, the Treasury reported collecting $297 billion in corporate revenue, 37% less than the $472.9 billion shown by the GOP. The shocking result is the effective corporate tax rate, and this is the important takeaway on actual collection, was 13% during Q3, which has been well below the 20% started last decade, last 10 years. So in other words, corporations will have much lower tax. They paid 13%. They didn't pay the 36%. So it would be much even lower than that. Had been mostly below the 20%, for the previous decade. So in other words, they're down to 21% now. They will be much, much below that. Consumer confidence, both for the Consumer Sentiment Index and the Confidence Index, jumped in October. I focus on the average of the two, which we'll call the Consumer Optimism Index. During October, the index jumped to 113.3, the highest since December of 2000. Its current component rose to 133.8, the highest since March of 2001. That was on the G.W. Bush. While its expectation component rose to 98.8, the best since 2004. The availability of jobs among the plethora of series, including CSI and CCI surveys of consumer confidence. During October, 36.3% of respondents agreed that jobs are plentiful, the highest record since 2001. Jobs hard to get percentage fell to 17.5%. That's the highest since August of 2001. Wages in the past, wages, was a reasonably good correlation between wage inflation and a jobs plentiful series. This was using the year percentage change in the average hourly earnings, or the employment costs. That's index, ECI. The latest data shows that the average hourly earning for production non-supervisory workers rose 2.5% during September, while wages and salaries rose 2.6% in Q3. Both remain surprisingly low given the plentiful jobs. So in other words, it's flat. Amongst the various stock variation agencies, Warren Buffett says he favors the ratio of the ratio of value of all stocks traded in the U.S. to a nominal GNP, which is a normal GDP plus net income receipts for the rest of the world. The data of this numerator is included in the federal quarterly accounts of the U.S. and like the GDP report, logs, However, the S&P 500 price to reverse revenue ratio, i.e. price to sales ratio, which is available weekly, has been tracking Buffett's ratio. A very clear interview in Fortune in 2001, Buffett said, "For me, the message of that chart is this. If the percentage relationship falls to 70% or 80% area, buying stocks is likely to work very well for you. If the ratio approaches 2,000, as it did in 1999 and 2000, you are playing with fire." That is the sage of Omaha. Advice. Buffett's ratio rose back to 179 in Q2, nearly matching the 2000 peak of 180. The weekly measurement rose to 198 in mid-September, yet Buffett chose to ignore that, predicting that the Dow Jones would be over 1 million in 100 years. He said in September, speaking at an event in New York marking the 100th anniversary of Forbes magazine, Buffett noted that 1,500 different individuals had been featured on Forbes' list of 400 wealthiest Americans since the start of the tally in 1982. That was when Reagan was around. You don't see any short sellers among them, he said, referring to those who expect equity prices will fall. He added, being short, America has been a losing game. I predict to you it will continue to be a loser's game. Buffett said, whenever I hear people talk pessimistically about the country, I think they're out of their minds. Anyway, adjusted for inflation, the CPI since December of 1920, the real has risen 2 to 4%, and 4 above is the base of long-term amortization return of the Dow Jones, ignoring dividends. Regardless, 3% real amortization returns and from net capital gains isn't far from the 3.3% of real earnings of the S&P since 1952. I'll just append this up here, but basically speaking, yeah, they're playing with fire. Let's move on here. We'll go backward and do the stocks. The BBC 30 down not a 0.99 in the negative there. The FTSE All Share 31.49. In Amsterdam, they were... they didn't show up. In Frankfurt, the DAC was down 62.30. This is on Friday, unless I was. The Calc in France, they were down 26.86. In Brussels, 13.48 in the negative. And in Madrid, 49.20 in the negative on Friday. In Zurich, 23, 0.93 in the negative there. In Moscow on Friday, 6.85. In Johannesburg on Friday also, they were in the negative, 294.82. In Bombay, 208.80. In Karachi, 100.17. In Lahore, they were in the negative, 45.11. In Colombo, 4.92. And in Tehran on Wednesday, they were in a negative 251.50. They're having some demonstrations in the street there. In Sydney on Friday, negative 22.10. The Nikkei, negative 19.10. And in Hong Kong, the Hang Seng was at 55.48. In Shanghai, 10.79. In New York, the Dow down negative 118.29. To that discussion we just talked about, the Santa rally, not there. The Nasdaq was also down 49.77. And the Merc, the commodities exchange out in the Midwest city of Chicago, was down 13.93 in the negative. In San Pablo on Monday, they were down 1,046.17 in the negative. And in Mexico, they've been in negative forever. On Friday, they were down 648.42 in the negative there. And to the commodities, some of our concern here, Brent crude was up 46 cents at $66.62. On the spot, it was down 28 cents at $58.59. That was on Wednesday. Texas Intermediate on Friday, $60.25, well, 41 cents. Can't sustain that with consumers out there. It's causing problems. Gold on the Forex was up $4.90 at $1,296.50. Dubai Gold was actually up $1,305.60. That was its total, and it was actually up $8.70. So gold has hit the $1,300 range. Very unusual. What's behind that? Stock market up. Well, stock market was down a couple of days, but gold is up year high. Silver up 13 cents at $16.86. Let's go to Unex Life Futures. Cocoa, again, these commodities up $182. And Robusta coffee was up $175. These are commodities all going up. We don't like it. White sugar was down $8.60. Oh, well, so much for the sweet tooth. The Bloomberg Commodities Index on Wednesday, 85.59. Interesting. One has to watch the commodities because the commodities is a very speculative market. And it, with a most speculative stock market, irrational exuberance. Now, what happens is when you have a trend, in other words, the psychology of the market, you have a very positive situation, but we're looking at corporate earnings are behind the market, and we expect that, at least what we see right now, but some of these corporate earnings, Apple should be down, and some of the others should be down and not necessarily up. We'll be watching the market very, very closely. Now, the commodity prices, particularly Brent crude, going up at $65 a barrel. And that translates into gasoline prices at the pump. And as we said earlier, with the savings rate down because of the Santa Claus holiday, people were making purchases either using their savings or credit cards. So all of this does not bode well. It's coming together. Will we see it in January? Well, January traditionally is a transitional month. Now, at least in the U.S., we have subpar temperatures in much of the U.S., and we'll see how that works out. Winter clothing, I've started to see at some places winter clothing going on sale. But if petrol prices are up now, or if they go up in, say, January and February, as we get more into the driving season in May, where will they be? And this is one of the big, we sort of wonder about it. And the tax season, will people actually get the refunds they expect? Or will it be the $65 for most people? Depending on where you are, it'll be from $65 up to, I don't know, $800-900 in the higher brackets, at least the first year. But will that be short-lived? There are a lot of if. The infinitive if is all over the place. Nonetheless, Happy New Year to everyone. We'll see you next week. For those in business, make it a productive week. It'll be a short week, obviously. And for the consumer, you have, as they say, your eyes have been on the prize. We'll have the next report. In January, the sales numbers for all the holidays. Did the retail people continue with their little Santa Claus helper program? Or will they go the way of the market?